the second episode of JEC Interviews, where we connect with leaders in business, economics, and finance to gain valuable insights from their experiences. My name is Nathuki, the president of the Junior Economics Club of Mississauga, and today I'm joined with my colleague Rachel, our co-director of marketing. And today we are honored to welcome Dr. Amos Nadler. Dr. Amos Nadler is the founder, CEO, and chief scientist of Prof of Wall Street, the world's first behavioral fintech venture. Prior to Prof of Wall Street, Amos was an assistant professor of finance at Ivy Business School at Western University and a visiting professor of economics at the University of Toronto and the Claremont Colleges. He served as the first chief economist in the digital asset space and as a due diligence expert for private wealth management. Dr. Nadler completed his master's degree in economics and PhD in behavioral finance and neuroeconomics at Claremont Graduate University, where he was awarded the Kauffman Fellowship, the GDP Forecasting Prize, and served as a senior researcher at the Center for Neuroeconomic Studies. Dr. Nadler, thank you so much for joining us today. How are you doing?
I'm great. Thanks for setting this up. I'm so excited to chat with you both and your audience, and couldn't be more excited about this.
That's great to hear. We're thrilled to have you with us as well. So let's dive right into our first question. So, what initially drew you to behavioral finance, and how has your perspective on the field evolved over the years?
What drew me to behavioral finance? I was initially a math major, so I don't know if either of you or a lot of folks listening are math majors, but so that's where I started from. I was a math major, and then I switched to economics towards the end. And it was like more of a pure play economics. Like this is a big state university in the United States. And then right at the end, behavioral economics started to become a lot more sort of popular. I think, so big Nobel Prizes were given while I was an undergrad. And this whole new field pops up that talks about how people aren't these like rational utility maximizers, but rather the people are people. And it's still our job as economists to figure out how people think, what makes them act this way or that, where do we make mistakes, where are we doing a great job. And if you start to relax some of these unrealistic assumptions about human cognition and decision making, then I think economics becomes a lot more interesting. And so your question about what drew me to behavioral economics was like relaxing some of the assumptions that I felt made the field feel very not human and not very accessible. So this feels much more human and much more accessible to me.
Yeah, that's amazing. Great to hear. So, your work bridges academia and industry. So, what are some of the biggest challenges in applying research to real-world financial decision making?
It's a bridge between research and real world decision making has been enlightening. Part of the reasons it's enlightening is that the people in academia are all trained the same way. We all have to take the same math, statistics, proofs, whatever. And so we all think very similarly. So right off the bat, it makes it easy to have conversations with people that think and are trained similarly. Now take those ideas, whatever that idea may be, whether it's about efficient markets, do we believe that markets are efficient or not? And then try to have a conversation with people who don't have that training or have it like maybe at the undergrad level or like the MBA level, but not at the PhD level. And right off the bat, the translation is very awkward. Partly they don't know the language and they might not believe in the assumptions. And so it's really difficult to go from like a professional grade academic perspective to carry that into under other professionals. That is like a totally different language and totally different set of assumptions. So right off the bat, I found that to be a huge challenge just from a linguistic and ideological perspective that people maybe don't believe that markets are efficient or they don't know what skewness is of a statistical distribution. So there's a big aspect there that makes it hard.
That's an interesting way to look at it. Really insightful. So, our next question is, how do behavioral economics and neuroscience intersect when it comes to improving investment strategies?
How does behavioral economics and neuroscience, was that the question?
Yeah.
Okay. So let's break that down. Let's break down what those two mean. So behavioral economics, as we talked about, is economics with realistic assumptions about how people actually think and act and make decisions. And then neuroscience, and specifically decision neuroscience, is based around how the brain functions when we're making mostly economic decisions, which could be financial, like buying, selling stocks. It could also be Marketing has been a big part of that. There's a lot of economists in marketing departments now, such as Wharton and University of Toronto, for example, and other great schools. There's these economists. So a lot of that language carries over to the marketing department, and we ask questions about, well, what parts of the brain are active when computing risk versus, say, uncertainty, or what's going on where you're dealing with like a sure bet versus something that is ambiguous. And so the same questions in economics or behavioral economics get carried over into neuroscience, where the tool set is totally different. We get away from just like writing proofs and setting up these like behavioral experiments, and now we're putting people on fMRI scans. Now we're putting people in like caps where we're doing, EEG testing. We're seeing what like the latency is there. My dissertation was on the effects of testosterone on stock traders. Yes, like we gave people drugs to see how it affect their stock trading. It was like wild experiment, paid off really nice. We got this great result. But when you talk about the intersection of neuroscience and behavioral economics, it's called neuroeconomics, and it's a field unto itself, and is, I think, shed a lot of light about how we make decisions and how the brain functions to set us up for possible interventions, possible tools to help people make better decisions
That's
overall.
that's a really great point. So our next question is, could you share an example of how AI and behavioral finance together have transformed financial decision making?
AI, you have to talk about AI. It's like the big buzzword of the last 2 years for sure. I think it's important we first define what that word means. Like the more clearly we define something, the less vague the answer can be. So when we talk about AI, what people often mean, I think what they're thinking now is like large language models. They're thinking about the consumer version of AI, like ChatGPT and Perplexity and blah, 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 and all the others popping up. When an economist thinks about AI, what we think about are maybe new models in addition to existing models. Like machine learning was the big term before AI was a big term. Machine learning is statistics. AI is statistics. It's just the application of it, we think about it, is different. And maybe that's where it gets interesting, maybe at the consumer level of like, well, what does a large language model do that's different from a non-large language model? Like what's the contribution there? So when you ask about the impact of AI and behavioral finance or behavioral economics, to me, the major takeaway, the major opportunity is actually identifying the problems that people have to make financial decisions, and then how can we harness technology to deliver the insights and guide the decisions so that people stop making the same mistakes they've made for the last 100 years, or you could say arguably hundreds of thousands of years, because the brain that we have today is essentially identical to the one it's been for a very long time. What's radically different is our current environment of making decisions very rapidly, through a computer. So I think the opportunity is massive, and that's really what Prof of Wall Street is about harnessing the best research in behavioral economics, pairing that with AI, statistical tools, and guided decision making to lead people to make good decisions. Whereas if they didn't have that technology, they'd be repeating the same mistakes they've made for hundreds of thousands of years.
That's really insightful. So, a bit of a fun question. What do you think has been the highlight of your entire career?
Highlight, wow, gosh. By the way, I'm not that old. Just as a heads up,
Yeah, of
not that old, guys.
course.
Come on now. But so far, I mean, gosh, I've had such a wild career. Like, it's funny, you meet professors, you think, oh, you've always been a professor, but like, no, this is like my, I don't know, fifth career. When I was an undergrad, I worked in high school. I had like restaurant jobs. I worked at a gym. I worked at like office supply stores. This is in California, Northern California. So I did all sorts of like, kind of blue collar jobs that were super fun, worked at hotels. And then my first professional job, I was 19 years old I got hired to work for a maxillofacial surgeon and to run his study club and then also represent his practice, doing continuing education and like making sure that patients got the best outcomes. So working closely with like the referring doctors. So I was like 19 years old, wearing a suit, as an undergrad. It's a pretty wild job. So that was like super fun. And then I started my own company, did marketing, PR, and healthcare, and then master's and PhD, and then I was a professor, and then I worked at hedge funds. So it's been like a crazy life. And now, Prof of Wall Street, this venture we're working on now that brings it all together in a really, really exciting way. I would say the most exciting part is probably where we are right now. And
Mhm.
right now requires the culmination of everything I've ever done before in order to succeed. So my most enjoyable part is having to reach back for tools I developed when I was 19 or 15 or 12 or whatever it is to have a conversation or develop code or work through, a complex question that somebody has about their future. And yeah, I find like when you really take chances in life, what it requires you is to keep stepping up and taking bigger risks. And I think that's really what life's about, is learning everything you can and then continuing to learn after that and staying away from the sure bets and staying away from the things that are sort of traps. Yes, it's terrifying. It's not always fun, but I think that's the way to go.
That's really inspiring. Yeah, it just enforces how the process is really important in the whole journey. So, on to our next question. What is a common cognitive bias that investors should be more aware of, and how can they counteract it?
A cognitive bias investors should be aware of. There's a set of them that I think make a huge impact. There's some that like are really impactful, and then there's some that are like maybe nuance. The challenge with any of them, and I'll list a few in just a second, is like we don't know how bad we have that bias. It's not like there until now, and there's a punchline here where I'm going with this, is until now there was never a way to measure the degree of bias that you have. Uh, One of the major biases that people have, and it's mostly guys are worse, like males tend to be worse at this than females statistically, is overconfidence. You've probably heard that word, overconfidence. It has like a super specific meaning in behavioral economics. And there's actually three different variants of it, but the basic idea is like either I'm better than other people, that's called overplacement. One is that I think that I know more precisely what something is, that's over precision. And there's a third one, but the basic problem with overconfidence is it leads to decisions that are out of whack with statistical reality. And what I mean by that is if you're overconfident or you're over precise, you might like buy single name stocks because you think you know where the price is going. And that over precision leads people to buy single name stocks and put a lot of money behind these positions because they're confident they know the direction. Like, oh, it's going to land right here in this band. And that's what we do at Prof of Wall Street is we measure the degree of bias in people's decision making, and we quantify how much that bias has cost them in terms of their investing background. Overconfidence is one. There's other behaviors such as loss chasing, where people are in losing position, they keep buying more and more in a losing position. There's that. There's also weighting, the way that people weight a portfolio. So they might put a lot of money behind one specific idea because of, and these are all kind of related, overconfidence. So those are a few. If somebody's investing at all in single name picking, they're probably overconfident at baseline. And I think that, and I had to go through this process of like reality kind of beating you up a little bit and beating out of you that overconfidence and teaching you how to be a bit more calibrated. At this point, I'm probably underconfident relative to where I used to be. So I'm not sure exactly where the perfect middle is, but that's a classic. Another one is risk aversion. That's the thing that probably makes us most human. There's nothing like, excuse me, like wrong with it. It's just that we overestimate the risk of certain things and we prefer a sure bet. And in so doing, we miss out on these like really good ideas or good opportunities because of the way that our brains are optimized. They're optimized to keep us alive. They're not optimized to keep us happy. So over precision, risk aversion, those are the big ones. There's other like ones that are interesting but don't hit quite as hard. I mean, loss aversion is another one where people are in a bad position and they won't exit the position. Excuse me, that gets people in a lot of trouble. I could go on and on. There's like over 30 biases. So I mean, we have, so much time to talk. I'm happy to share. I think we have an article, a blog post about this. But I think what's helpful about biases is having language. And that's one of the parts about behavioral economics when I taught at Ivy. It's not necessarily about deriving the proof for something. It's just having words to describe some phenomena. And when you have the language to describe it, you're better able to actually do something about it and function better around that thing.
That's a great load of information to take in. So, going on to from my last question from myself, what do you think was what pushed you to start Prof of Wall Street? And do you have any advice for people trying to start their own business or their own organization?
What pushed me to start Prof of Wall Street were two major events. The first event was this sort of growing discomfort that I had in academia. I thought that I wanted to be a researcher. I thought I wanted to be like a purebred, just sit and publish papers and go to seminars and teach conferences and be a keynote speaker and, maybe someday win some fancy prize. But what I found was what I really wanted was impact. I really want to have an impact on people. Like we put a lot of time and effort and money into our education. And the last thing you want to do is to feel like it doesn't matter. I think meaning is really important for people in general. I know for me it is. And there are just certain sort of cues I got when I was in academia that there like wasn't really a good fit. Also coming from kind of a California like innovative culture and being incentivized for being innovative, I found myself struggling within, at least this academic environments that I were in was more about maintaining kind of the same tradition. And it just wasn't a good fit. So what led me to start Prof of Wall Street was the desire to make impact, to have an impact on the world. And who's a better person to do that than someone that sacrificed, half of their adult life getting a PhD and learning things that the general public doesn't understand and needs some translation with. So I thought, I'm that person. I'm one of the few people that has this crazy entrepreneurship, bent and put the time in to study and to, earn my stripes as an economist and be a professor and publish in top tier journals and be associated with some of the smartest people in the world that I'm very grateful for their mentorship, for their friendship and all of that. So I felt like that was for me, like it was my calling. Now, a few years ago, I wasn't sure if I was going to start Prof of Wall Street or not. I was working at a quantitative hedge fund in Toronto, some, very smart people. And actually it was tragedy that got me to start Prof of Wall Street. This story I don't talk about a lot. It's actually hard to talk about, partly because this happened during COVID, and I don't know if you saw this story, but I think it was like 2022, and there was a college student, I think he might have been in Austin, Texas, in the US, where he was trading, I think, options on Robinhood, and his account read that he had lost some astronomical amount of money, like 700 something thousand dollars. And this college kid killed himself. And he wrote a suicide note. Like, why does someone at 20 years old have access to this amount of margin that I could lose that much money? And when I saw that article come out, I was so struck by it because he kind of reminded me of one of my students at Claremont. I taught at the Claremont colleges in Southern California, and just reminded me of one of the students that I had. I taught there when I was like in my 20s, and I was like so hit by it that I decided to start working on technology that's based in behavioral economics that would help investors avoid huge mistakes. And this was early on, probably, retail investors, but now I work with professionals. But at the time, I was like, people need help. Just because you're a self-directed investor doesn't mean that you shouldn't have any guardrails. It doesn't mean that you should have enough rope to, pardon the analogy, but have enough rope to hang yourself with. Like there should be something between somebody managing your money and you having the ability to like lose all your money plus, your parents' money. So it was like so to wrap it all together, it was the culmination of a history of entrepreneurship, the desire to make a difference, finding out that academia, as much as I love a lot of things about it, limited my ability to have exposure to the outside world and have impact on the millions of people who need that input. Just like what you guys are working on, it's critical that people get access to this. Like everyday people need improvement in terms of financial literacy, need tools to not make the mistakes that we're sort of predetermined to make, from a neurologic perspective. And I needed that tragedy to shake me up and say, like, I feel terrible about what happened. And I feel I'm ready to take whatever risk to make sure that this doesn't happen and that this technology makes the world a better place.
That's a really inspiring story to share, Ms. Dr. Nadler. Thank you so much. So I'll now pass it over to my colleague Rachel to continue with the next part of the interview.
Thanks, Nithuki. I really appreciate all the valuable insights so far, Dr. Nadler. Moving on to the next topic. Many young people are interested in investing but feel overwhelmed. What's the first step they should take to develop strong financial decision-making habits?
A lot of people are scared to get started with investing, partly because, and this goes back to one of your questions about biases, complexity aversion. Just like it sounds like, if something is like kind of pushes your buttons, you don't feel like you understand it, you feel dumb or intimidated, people back away from those things. We all do it. Unless there's like sufficient motivation to deal with that thing, we don't do it. So people are, I think, intimidated by financial markets. They're not sure where to start. Sometimes they don't get help at home. At school, it's not something that at least historically has been a lot of financial literacy provided. Although this is changing. Like I'm working with university, there's some big schools or big school districts in the US are working with to help change this. There are like clubs and of course what you're working on to help, provide financial literacy early on. The first step I would say is like don't wait for it to be simple. I would say the first thing to do is maybe open a paper trading account and just start to dip your toe in and learn the difference. Like what is it? What is equity? What does that even mean? What's a share of a company? How is that different from like a bond? And why are their like return profiles so different? Like why does the stock price move around so much, but the returns are much better than these bonds? Like the price doesn't move that much and the returns are much smaller. Like you just got to begin. I just think it's part of being like an adult, and if you don't have that financial literacy, you get excluded from certain conversations and you get excluded by your own doing from growing wealth over time. I'm not saying that every retail investor is going to become a millionaire or become a billionaire, but I'm saying that there are tried and true methods that over long periods of time increase wealth. So for people who are young and are intimidated and scared, like it's okay. All of us were. I was intimidated. I remember that kind of on-ramping that I had to go through. It's okay. Don't let it stop you. If you want to become a good swimmer and the pool's cold, you're not going to go in the pool. No, you're going to jump in, you're going to be cold, and you'll be fine. So let's take the opposite end. What not to do is don't take all of your money, open some, brokerage account and just dump it all in a single name. Like, I don't care what you read on like Reddit or whatever's going on in the news. Like, don't do that. Like, even if you get something early, you're going to probably mismanage the win and you're probably going to end up losing it. Like, the news is not good. Like, social media is not good. The incentives are all backwards. Uh, I would say start paper investing in like the S&P 500 or some low cost ETF. Learn what that is. Like, don't put any real money at play until you've mastered your own biases. And this is what we do at Prof of Wall Street is we do help people who want to start becoming investors. We have what's called paper training, and we have a guided investment process that walks people through the investment decision so that they know, oh, I should think about, is this appropriate for my portfolio? Is this an asset that I should own or not? I have to think about, well, what's realistically the return profile for this particular investment? And through kind of having them think through the process, it elevates the quality of the decision. So I would say for young people that want to learn how to invest, don't go and put a bunch of money in some single name stocks. What you want to do is either open a paper trading account and start to learn the language, start to learn how it feels to do well, learn what it feels like to lose money based on paper. And if you want to try a paper trading account at Profit Wall Street, you can use our guided investment tool, and maybe we could allow your organization to have access to it. Because the idea is to de-bias before you allocate real capital, but how do you know how biased you are until you have data? So we're most helpful for people who have data because we can analyze the data and provide you insights about what biases you have. But if you don't have any data, you got to just get started and like just have fun with it, but don't put real money at play yet. It's probably not a good idea.
That's great advice. On a related note, I wanted to ask you a question. I wanted to ask about what are some financial behaviors or habits that separate successful investors from average ones?
What are sort of behaviors or habits that separate successful investors from average
Yeah,
ones?
financial behaviors or habits.
So there's two parts to that. The first part is you have to have good financial hygiene to even have the money to invest. Like, so the second
Mhm.
part will go about the tactical aspect of investing. But if you don't have good discipline and say you're spending all your money on rent or a car or stuff, going out all the time or you name it, you won't have the money to invest. So the best thing for young people to do is to learn discipline. I know it's tough. It's like you want to have the cool stuff, you want to show off, and like I get that. Everybody wants to have the coolest whatever, the shoes, for us it was like back when I was a kid, it was like starter jackets and the cool Jordans and whatever. Like every generation has its version of it. Like whatever is the cool, what's cool for you guys? Like what's the cool hip thing that's super expensive that people waste money on?
Um,
iPhones, I'd say. Yeah.
Oh, it's
I,
iPhones. Yeah.
I just feel like I don't know, like fidget toys or like anything that's like weird, like cool, just like I don't know, just like different stuff. So
A lot of social media
yeah.
influence, just like what shows up online that goes trending, things like those tend to sell a lot.
Yeah, and then you got to like have it to be cool. And
Mhm.
I mean, iPhones are pretty expensive. That's like, but a little like a shirt. But these things add up. And the point is like, as you become accustomed to buying things, it becomes a habit. And then we become accustomed to like having no money in our accounts, and then we get used to that. And I think that one thing that I developed really early on as a kid, was the appetite for savings. And I was lucky enough to I was actually got a job really young. It's a long story. Maybe another interview. Was I had money, and I didn't need all the money. And I walked to the bank and I noticed there was like checking accounts had very low interest, and there's this thing called in the United States certificates of deposit. And it's basically it's a little bit less liquid than say a checking account or a savings account, but like you get a lot more interest. So I was sitting there, I was like 10 years, 11 years old. I was like, well, why wouldn't I just do that? And the person in the bank was like, well, I don't know, just put the money in there. So I was like, is this a trick? It's like double the interest. So early on, I started getting this sort of appetite for saving for yield. And I had like good financial habits that I was fortunate to develop. So if you don't have good financial habits, you're probably not going to be a great investor, because some of those, A, you have the capital from saving, and then B, some of that discipline will carry over. Having that sort of inhibition will carry over into good investing. So saving the money is the first part, and then having the money to invest is the second part. So the habits, the biggest kind of bugaboos of investing are over trading. So people will like react to things, prices go up, prices go down, and just that instinctive reactivity, people trusting their guts when they're trading. Like, unless you're a very well-honed and trained trader, you're making mistakes left and right. So the biggest problem when I first started reading the literature on this when I was a grad student was over trading, was making decisions too frequently. So right off the bat, I was like, okay, well, people just didn't trade as frequently, they probably wouldn't lose as much. So I think that's true. That's one. Picking single name stocks is another one, but that's all we ever talk about is like, oh, buy Tesla, short Tesla, like, the Mag 7 and Nvidia and Microsoft and Amazon and blah blah blah. And like that's all people talk about. But it's like actually the worst thing that somebody should be doing right now is picking single names, because they're going to mismanage the wins and the losses either way. And we could get into some details about it later. But developing good habits of avoiding single name stocks, because you don't have the time to do the research and you don't know more than the market. Like if you buy a stock, you're assuming that there's some sort of benefit to doing that that's not already priced into that stock. And it goes back to our earlier question about overconfidence. Like people are overconfident. Oh, I know more than they do, or whatever. You probably don't. Like there are people who work at hedge funds or analysts, and like that's their full-time job is buying and selling, assets according to information that there's no way you have. So I think we have to develop a certain kind of humility, even though the general social narrative is about like, YOLO and I know better than you. Like you don't. You can get lucky, and sometimes luck is part of it, but like systematically over time to do well, that is like a very small minority of people that can do that. So I hate to be like the bearer of bad news, but it's better to learn it now than learn it, like some kids have how to learn the hard way. If you learn that now at whatever specific age group you guys are targeting, those people will be much better off and make way less mistakes than people who learn through investing through trial and error, which is really painful. And some people do so poorly that they never come back. And that's a tragedy, because you don't participate in financial markets. When if you learned the right way, you might have just maybe had a dollar cost average strategy into the S&P or something that, over long periods of time significantly outperformed what you could have done trading or putting it under the mattress. So I think that's the tragedy, and it's not obvious. I mean, I'm curious if you just grab that clip of what I just said and put it out there, like how many people have heard that before? I sure didn't when I was a younger person.
That's really insightful. Thank you for sharing. Let's move on to our next question. With the increasing role of AI in finance, do you think human intuition will always have a place in investment decision making?
So with the increase of AI and
Mm-hmm.
tools, will human intuition have a place?
Yeah, with the increasing role of AI in finance, yeah.
It goes back to what we mean by AI. I think that the human brain, is biased and flawed as it is also unbelievable, is like absolutely astounding. If you like, once you study the brain and you see how sophisticated neurons are and how they communicate and how the branches like go through your brain, and just understanding how complex a synapse is, like you start to appreciate how amazing our actual like hardware, wetware, software really is. It's really impressive. The role that AI, which I'll call machine learning and statistics, is it can interpret the world and give you inputs that are much more precise and much more instructive than whatever noise we would have gotten in a qualitative sense. Like that might sound a bit vague. So let's think about like running like a regression, like a regression outcome. So a regression, like ordinarily squares, is a statistical approach to find out, what the relationship between variables, kind of putting it simply. And that's really helpful. Like if we look at a data set or we look at something in the world, like we're just going to have our own kind of biased perspective of it. But if you study it and you have a clear analysis of that situation, then the inputs into your brain is, oh, the beta on that is this, and the standard errors are very, very tight. The economic impact is this. Like that is called supervised learning. That's called regression analysis. It's extremely helpful to then understand some phenomenon in the world better than you would if you didn't have that. So either I'm going back to OLS, which isn't new, it's been around for hundreds of years, but the ability to get data in near real time, analyze it rapidly on the cloud or even locally and get insights, like that's a whole workflow that has improved human intuition because the inputs are so good that your intuition can actually process it in a really effective way. The people sorry, go ahead.
No, go ahead. Continue.
The people that will outperform are those who use the right tools and provide their brains and provide their intuition with the good signals. Because it's garbage in, garbage out. And so if you're ingesting quality information, which is like not news, not Twitter, in its raw form, if you're ingesting it from a kind of digested, clear format, I think your brain will actually be able to be a much better decision maker and you'll be much more effective in the role. So I think intuition is largely aided by good data, correct data, digested, kind of denoised, cleaned up data. I think people do much better with that than they would without it.
Okay, so that was very enlightening. The next question I would like to ask is, what's an underrated economic or financial concept that young people should pay more attention to?
Underrated concept. I don't know how exposed people are to economics in general. Like, I didn't take it until I was an undergrad. We didn't have it at high school. They had like home economics, which was baking. I'm not a good baker. My wife's more the baker. I'm not a good baker. I like to cook more. But the concepts, like, I think that learning the fundamentals of economics, even though, as like behavioral people like trash talk neoclassical economics, it's actually really good just to learn neoclassical economics. Like learn something like the law of large numbers. Know that the more data you get, the closer you get to the true statistical distribution. This might sound like wacky or abstract, but it's like our biases come from small samples. And when we realize that like, oh, that's just something I saw and I'm overgeneralizing it to the entire world, like you're lacking the humility to say, oh no, that's a small sample, or I'm biased because that's what I believe. And I saw that little bit of information just validating what I believe. So learning statistics, which is really inseparable from economics, is like law of large numbers is really helpful. That's one I think is really great. The other one is, again, knowing overconfidence and knowing how that can lead you astray. It's like that self-check, like I'm probably being overconfident here and the outcome is so bad if I'm wrong that I don't want to do it. Like that's a kind of a wisdom that comes from it. Again, even just knowing the language around it. One of the fundamental concepts in economics in like neoclassical econ is diminishing marginal utility. And diminishing marginal utility means that every additional unit of consumption of that thing yields less and less pleasure. So I think about that with like something as simple as like dessert. Like I'm okay with like half a cookie, or I'll have like an orange for dessert. And other people like want a whole piece of cake or a whole thing of ice cream. I'm saying on that like 15th bite, how much more utility are you getting out of that ice cream or out of that cake? Like you're getting almost zero. And so that's why the utility curve is like this. It's saying that, the initial first bit is like a big utility increase, but as you go like this, it kind of flattens out. So the first derivative is positive, second derivative is negative. And even though this concept might seem like abstractly, nerdy or whatever, it's like it's really relevant to our lives because we can overconsume some things and totally underconsume other things. Like it could be entertainment or social media. Like, read a book. You'd be amazed how good it feels to read a book versus being on Instagram or whatever for like 2 hours. Like we just go into almost disutility. So I just think having language around our habits and recognizing like, yeah, I only need this much to get this benefit. And after that, there's no benefit to it. What am I doing? I think that's really helpful, both on doing over consuming, and then there's under consuming. Like I could use a little more financial knowledge, and that early up ramp will give me a lot of value, or maybe down the road that's more nuanced. I'm not necessarily saying that the cost benefit or the returns to financial investment are diminishing, but just to be aware of these concepts that exist in the real world are really helpful for us, and we have language for it.
Okay, so that was really fascinating. So taking a step in like a different direction, so with your background in marketing and branding, how do you think psychology plays a role in financial product adoption?
Mm. There's a really nice paper. He's like one of the like founders of the field of behavioral finance, and I have his book on the bookshelf over there. Mayor Statman, I'm a big fan of his. He's at Santa Clara along with Hirsch, and yeah, they're both like the founders of the field of behavioral finance, along with Dick Thaler. He has a paper talking about the like behavioral economics of financial product marketing, and your question is more about psychology, but like in some ways, some of behavioral economics is social psychology. If you look at Kahneman and Tversky, who won the Nobel Prize in 2002 for it, they were originally social psychologists, and they talk about things like representativeness, and that has become part of mainstream economics, but it's like very much social psychology. The difference between economists and psychologists is largely like, so some of the assumptions are different, that we assume, economic models are more deep and narrow, while psychology tends to be more like a lot more ad hoc models. But in terms of like marketing in finance, like I feel like it kind of uses it in a way that's anti-consumer. It's like, I mean, look, they're just trying to sell something. I get that. Like at Prof Wall Street, we do too. It's not like anybody's immune from it. But like the idea of encouraging somebody's overconfidence, I think that's not good. Like I think you're doing someone a service if you're correcting their overconfidence. But like a classic, often used technique is scarcity. Humans respond to scarcity. We also respond to time limits. So if you say, for a limited time only, and there's 5 of them left, people respond. I mean, next time you buy an airline ticket, you're going to get hit by all this like behavioral economics and like psychology in marketing. It's filled with it. And all of those big companies have armies. Amazon is an army of economists. I can't comment on all the others. I know Microsoft has economists, although I don't know if they're necessarily working on marketing. But like there's a lot of behavioral economics and psychology on the marketing side for all products.
Okay, so that's a really great point. Moving forward, you work with investor of the highest levels. I was wondering, what's one surprising insight you gained from observing professional financial decision makers?
What's an insight from looking at professionals? The the thing that surprises me, and I think surprises all people, is that they become extremely strong in certain areas and maybe show no, like they wipe out certain biases, like they're just gone once through experience. But it doesn't mean that they're not biased at all. In fact, there's even some work. John List at the University of Chicago has a paper on this, along with, I think his name is John Haidt, Haight, I think. And they show that professionals also are biased. There's a paper showing mutual fund investors also invest in like lottery stocks the same way that retail investors do. So the thing with professionals, and this is going to make everybody uncomfortable who's watching this, especially if they have a pension fund, is that the professionals managing your money at the portfolio level or your financial advisors, they also have not just biases, but they have incentives that may not always move in the direction of the consumer or of the client. So that's an observation, and that's also from reading the research on it. The other part is a big difference between quantitative and non-quantitative decision makers. Like that's kind of a dividing line. And so that's why I recommend to people, even if they are currently professionals, is take some time and like learn some statistics or brush up on your statistics, because by knowing these things, it de-biases you and makes you a better decision maker, which leads to better returns, which leads you to keeping your job and your company doing better. So I do try to impart that to people and professionals when I work with them, is like, look, you might be extremely strong in these areas, but these weaknesses don't go away. In fact, they become bigger blind spots. So I have a lot of respect for people who can outperform over long periods of time, like props. All it takes is one big mistake to wipe out the gains you've made. But there are people who do have ability, and I've worked with people like that. Portfolio managers is one I'm working with now out of New York City. Over the last decade, he's outperformed the S&P dramatically through every wild, twist and turn of the market. And I've measured his biases. This is something that we do at Prof Wall Street is people submit their trade history and we evaluate the biases in their behavior, and we can find out where their strengths are, maybe where there's like some weakness where they could improve that weakness and have a big upside. Some people really impress me, and they can't even articulate why they're good at it. That's what's really cool, is that, like, back to your point about intuition, is like they just do it right. Even though they can't even describe the bias, they can't even describe why they're doing it well, they just do it well. So I'm always impressed by that.
That's really insightful. So as we wrap up, I'd like to ask one final question. If you could give one piece of career advice to students interested in behavioral finance or fintech, what would it be?
For fintech or behavioral, I would say like get involved, reach out to someone that inspires you, take a project that's way over your head, or not, not the point that you stay up at night, but like do something challenging. I think reading books is great. Look, I was a professor for a long time. My company's called Prof of Wall Street. I'm all about reading books. Yet there's no substitute for doing something experiential, such as opening a paper trading account, working with a fintech firm. Prof of Wall Street. We have interns, we have externs all the time, and I'm blown away by their talent, by their dedication to the projects. And I always seek to find a win-win. Like, here's something that we need, and here's what you need in terms of your growth trajectory, and let me make sure that you get that. So I would say just get your hands dirty, make sure you do the hard thing first. Like, that's the advice I give to every people across the board. Nobody likes to hear it, is like, do the hard thing first. Like, do the math part first, learn learn whatever it is you need to do, because you don't want to be later in life and be like, oh yeah, I didn't take statistics, or I didn't take linear algebra. Now I can understand how this like computer software code works, or like whatever it is. Like, I find that I've kind of buffered myself against I've sort of future-proofed myself by doing the really hard things that I didn't want to do. I did them when I was really young. And I think those habits are from like sports. If you play sports, like play hard and be the best that you can be, and like crave the pain and crave the discomfort. I know this sounds like masochistic or like David Goggins crazy, but like if you shy away from pain, you shy away from discomfort, you'll always shy away. And if you can turn that around and have an appetite for challenge, have an appetite for pain and discomfort, your trajectory in life will be totally different than somebody who's like, oh, I'm uncomfortable, I'm going to stop, I'm going to back off. Like, that's where things split. That's where things turn. And I started going to the gym again recently. I took a bit of a hiatus, but all the pain, all the gains are in the final little bit, like the last 3 reps where you're like, in so much pain. That's where the gain is. It's not in the first whatever that are easy. So if you think about that as an analogy for life, that you're taking easy classes, you're skating by, like anybody can do that. And in this world especially, you don't want to be vulnerable. You don't want to, I don't mean emotionally, I mean professionally. And the best thing to do is to do the hard thing and do it early and set yourself apart and be valuable to people. Offer people value. Make sure that what you can do, not a lot of other people can do, and that it delivers value to people in some meaningful way.
So those are really excellent advices. I want to thank you so much, Dr. Nadler, for taking the time to share your insights with us today. It's been a pleasure having this conversation with you.
Likewise. Great meeting you both.
And with that, we conclude our second episode of JEC Interviews. Thank you to everyone for tuning in. Be sure to follow us for more conversation with industry leaders. Until next time.